Hello everyone and welcome to another weekly video update. Now we have a lot to cover today, starting with the recent CPI data from the US, but moving on to probably what's most important, which is what's happening overseas. Got some interesting data coming in from China as well, and of course Japan, which is the big thing to watch now in macro, in my opinion. So we'll definitely be talking about that as well, and then going over our charts. So starting with the CPI data, of course, we saw that continued trend in disinflation coming in on the Wednesday CPI data. We did, however, get some more, let's say, signs that disinflation could be a little bit sticky. We got, for example, the producer price inflation month on month coming in at 0.3%. Okay, so as we can see, that was obviously above market forecast and the biggest increase since January. Now, I also wanted to point out this tweet from Bob Elliott. He's talking here about the effect of wages on the inflation. And this is also something that I've talked about in terms of that narrative of, disinflation being a little bit sticky, is the idea that, of course, given the structural nature of the high level of employment, we could definitely see inflation struggle to come down. And this is part of what Bob Elliott points out here. He says elevated inflation will persist as long as nominal wage growth significantly outpaces productivity growth. Wage growth data today shows 5.65 to 6% wage growth on a matched basis among those with the highest propensity to spend, too high for inflation to durably fall to target. Okay, so definitely interesting to see that data coming in when it comes to wages. And like I said, I still believe that, we're probably heading towards that deflation. But, in the path, I do think we could see a little bit of that sticky disinflation, as I've mentioned before. Now, moving on also to China, right? So we got the banking information from China. China July new bank loans tumble, credit growth weakens further. Okay, so quite bearish here for China. Weak credit readings add to flurry of gloomy economic data. July new loans 345.9 billion yuan, lowest since 2009. July M2 money supply plus 10.7% year on year versus forecast of 11%. And central bank pledges to maintain support for economy. More rate cuts expected, but appetite for borrowing very weak. Okay, so we have China in a very interesting situation. As we know, we've had that GDP coming in quite low, and for some time the the PBOC, the People's Bank of China, talking about starting to ease credit, but we haven't seen any kind of very resounding actions yet. And China is a lot more limited, we have to understand, when it comes to credit issuance and using monetary policy and also fiscal policy to an extent. In fact, a lot of the problems that China has today, as I pointed out in the more recent newsletter, come from the fact that we had that big fiscal stimulus back in 2008, and that's kind of what propped up the kind of bubble that we're seeing, especially when it comes to construction and housing in China. So I think the Chinese officials are quite wary of trying to basically affect the economy using fiscal policy, and they're also a bit wary of doing so with monetary policy, right? Because and China is not the US, and they can't just print limitlessly. Now, more important than China, though, of course, is the Bank of Japan, of course. And, this is something that we mentioned a couple of weeks ago, but also in the newsletter, but it bears repeating because, this could have very strong implications towards the general outlook for macro. And, we have been talking about a possible credit event. Michael Gayed calls it a global margin call. And of course, this does stem from the fact that the Japanese yen carry trade could be unwinding. Now, we got some news, when was this? A couple of weeks ago, of the Bank of Japan basically trying to ease that yield curve control policy that they've had for some time. Now, we can see this here. We can see the policy that the Bank of Japan has held for pretty much the last 10 years. Okay, so we can see, for example, here, how short-term interest rates fell to about zero starting in 2013. And basically, they started that yield curve control, right? Where the yield was capped at 0% for a few years, then 0.1%, up to 0.25%, and more recently, up to 0.5%. And the Bank of Japan said that it would only intervene to buy bonds at about 1%, okay? So basically trying to undo that yield curve control. And of course, the reason behind this is that Japan is also fighting inflation, and it's fighting inflation for the first time in about 20 years. Okay, we can see here, obviously, Japan has been notably in deflation for a long time. That's actually part of what's made this yen carry trade possible. But as we can see, in the last year, inflation levels have approached 4%. And, this is something that the Bank of Japan eventually has to step in and stop. Doesn't want to. Again, it could have some very serious repercussions for markets, but it's trying to do so, right? So let's have a look at how this plays out in terms of the yen and the yen bonds and what this means for markets in general, right? So first off, looking back at the reaction to those words from the Bank of Japan, we can see here that the yen appreciated as the yield curve control restrictions were lifted and yields were allowed to rise. Okay, so we got that quickly following the announcement that the yield curve control would be loosened up. But interestingly, then the Bank of Japan conducted emergency bond buying only a couple of days later, as the yen was also beginning to spike a little too fast, right? So actually, we saw the Bank of Japan kind of walk its policy back when it saw such a strong market reaction. Now, this chart only goes up to about the 10th of August. Of course, since then, we've actually seen the Japanese bonds continue to climb higher and the Japanese yen also continue to climb higher, which is interesting, right? You'd expect, the Japanese yen has actually depreciated, right? This is the dollar Japanese yen exchange here. So as we go up, this is the Japanese yen actually depreciating at this point, while the bonds have actually continued to go higher, now approaching about 0.58%. Now, the question is, why is this so important for global markets? And the answer is the yen carry trade. Now, the basic idea behind this trade is quite simple. You borrow in Japanese yens because the credit in Japan is so cheap and invest basically anywhere else, okay? You are essentially shorting the yen and going long US equities or other more risky assets, right? This is due to the price differential in the yields, right? Japan has had very low yields for a very long time. We can actually see that on this chart. And basically that creates an arbitrage opportunity. Now, again, since this is essentially a short yen play, this also means that in order for this carry trade to work, the yen has to depreciate, or well, if it depreciates even better, or at the very least, it has to maintain its value. What you don't want is to see the yen appreciate. Now, what's important to understand here is that, of course, if people are using this cheap kind of Japanese funding, it's actually helping increase asset prices around the world, right? It's helping markets in the US. And that is why it's so relevant to global macro and also to US investors. Studies show that back in 2008, perhaps it was this unwinding of the carry trade that really contributed toward this collapse in financial markets and this 2007, 2008 credit event. And this is something we can see in this chart, which again, I pointed out a couple of weeks ago on our weekly newsletter on Substack and Seeking Alpha. And on this chart, we can see here in black, this is, of course, the US dollar Japanese yen exchange. And we can see how it fell pretty dramatically, right? Going from about 150 almost down to 60 here. And in a pretty short span of time, that is actually the yen appreciating, right? So as we see this black line go down, the yen is appreciating. What does that mean? Of course, that means that everyone who's shorted the yen in this carry trade, right, who's borrowed in yen, is having to basically is losing money, right? Because they have to give back the money in yen, which is now appreciated. So they're unwinding this trade. It's kind of self-fulfilling because as they unwind the trade, the yen also appreciates more. It's kind of like a squeeze. And basically, this means that there's less money, let's say, going to global assets, right? So we can see how here, of course, how the NDX basically collapsed, okay? Of course, during that 2008 financial crisis. Of course, there was a lot more going on leading up to this credit event, but the yen carry trade certainly played a big role in this, okay? And now, of course, the latest actions from the Bank of Japan are threatening to once again unwind this carry trade, right? If the yield curve control is loosened enough, bond yields in Japan rise enough, and the yen rises as well, that basically unwinds that carry trade and basically could have a similar effect 2008, where basically we can think about it as liquidity, really, because people are borrowing in the yen, and once that trade is no longer working, then there's basically, in terms of liquidity. There's a lot less liquidity supporting those global markets. And that's when we could see a significant turn in US equities. So definitely something that's important to point out. The other thing is, of course, that, we're approaching a time now where I've said this for a couple of weeks, I like to be a contrarian, and you look online and everyone's been very, very bullish lately. We've literally had, I believe it was one of the big banks, JP Morgan, Bank of America, coming out, talking about the idea that the soft landing, the idea that we're not getting a hard landing, blah, 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 all that good stuff. We've got, of course, GDP data recently coming in hotter than expected. So, everything is going very well. But just wanted to point out this chart, which I shared on Twitter a while ago, and basically a couple similarities we could say to today. And the first point that I make here is that recessions, we only and the first point that I make here is that we don't always know that we're in a recession, right? So my question here was, are we already in a recession? So we can see here that though we now categorize 2008 as a year of recession, the second quarter gave us 2.3% GDP growth, which followed the Bear Stearns rescue and claims in September 2007 of a soft landing. So again, we can see here, Dallas Fed back in 2007, just as the market was topping, just almost exactly as the market was topping, saying that, we had a soft landing. Of course, then we had the Bear Stearns debacle, where, of course, they had to be rescued, but, crisis averted, right? And then, of course, during this first quarter, 2008, even though this is now a recession, right? This area here would now be highlighted in gray. We actually got 2.3% GDP growth, and we did see markets rebound a little bit. And of course, we know what happened after that, right? So, of course, we have very interesting similarities with, first of all, of course, people coming out now discounting that idea of the hard landing. A lot of consensus analysts now basically saying we've avoided the hard landing. Of course, the Bear Stearns collapse kind of also reminding us a little bit about that regional banking crisis, which, we had 3 months ago and everyone seems to have forgotten about, right? Apparently not a problem anymore. And again, this GDP growth, which, just because we had high GDP growth this quarter, that really doesn't mean that we have escaped the recession. Could in fact mean that we're already in a recession or approaching one, more likely. And this basically takes us back to the old, very reliable signal of the yield curve inversion, which again, everyone seems to have forgotten about. The yield curve is very inverted and it hasn't uninverted yet. And, just looking at this chart very simply, we can see very, with a lot of accuracy, it is the yield curve uninversion, which precedes the recession. We are definitely not there yet, right? And we can see this happened here in 1990. We can see it happen again in 2001, and we can see it happen again in 2008. Again, very reliable indicator. We can even see it happen here in 2020. And no one is really talking about this anymore. People seem to have forgotten this idea. And this basically points us towards the idea that we could be entering that recession maybe sometime in 2024, Q1, Q2 again. I also talked about different timelines for this, but basically, if we see here a couple of examples, we can see, for example, June 1989, we began to uninvert. And then by about August 1990, we entered the recession. Right here, we could say we bottomed, the yield curve bottom around December 2000. And then by about April 2001, that's when we entered the recession. Okay, so this could give us a bit of an idea of the timelines that we're looking at here. Okay, so like I said, we're looking at maybe 2-3 quarters possibly. So, definitely important to take that into account when it comes to assessing the risk in the market right now. With that said, I thought it'd also be interesting to share this table. This was shared by Swordfish Vegetable on Twitter. Interesting handle. So here we see the market returns following previous Fed pauses. And, I have personally said before that, Fed pauses tend to be quite bullish. In fact, if we go back a lot longer, we can see in this table that, they're not necessarily actually that bullish. Okay, so yes, Fed pause 2018 was bullish, Fed pause 2006 was bullish, and this is kind of the scenario I've been talking about, right? Because I do see, I mean, we were just looking at that chart in 2006, prior to the 2008 collapse. So that was, of course, so we paused in 2006. We got a little bit of a continuation rally, but then eventually collapsed. But if we actually look at other instances, we do have a lot of instances where the S&P performance over 6 months was quite bad. Also over the next 12 months, we can see that performance, kind of a mixed bag, not necessarily that great. And again, if this is a situation like 2006, so you got that 6% increase. In fact, you got 18% increase over the next 12 months. But, then eventually, of course, you got that 40-50% correction. So, gotta weigh those out, really. So we have the possibility of that global liquidity event. Obviously, we're kind of bearish on stocks. We will go through those charts. Before that, though, I want to talk about Bitcoin because I'm seeing here some big potential that we could see a strong divergence between Bitcoin and stocks moving forward. This is something that I discussed with Ryan Wilder in the recent podcast. If you haven't checked it out already, you can check it out, Spotify, also here on YouTube. Now, from a technical perspective, this makes sense. And it also makes sense from a fundamental perspective. Now, as I've mentioned already, we've already had a kind of credit event to an extent this year. And that was, of course, that regional banking crisis. Now, when did that regional banking crisis start? Well, it started with the collapse of Silicon Valley Bank, which was around 10th of March, which was right there. And what did Bitcoin do? It went from about 20,000 to 31,000 in a matter of a month. Okay, so that was actually a period where we already saw that divergence between Bitcoin and stocks, and we saw Bitcoin react very well to that event. Okay, now in the case that we get another liquidity event, can Bitcoin continue to rally? It's definitely a strong possibility, and the charts also make a lot of sense. Now, first of all, obviously, if we look at my Elliott wave count here, now I'm looking at a couple options, but my main option is this that we have here, right? Where this was an initial wave 1, topping here in 30,000. This was a wave 2, going back to 24,000. And what we have now is a very good 1-2 setup to go up in our wave 3 of 3, okay? And just to see this a little bit better, basically, we can see that this would project us towards, I mean, if we were to measure this whole wave 1, this whole thing as the wave 1. So as we can see, the 1.618 extension measured from the bottom of that wave 2 leads us up to, possibly 60,000, even 76,000. So, breaking back above all-time highs, that would be, of course, the top of our wave 3. And then we'd still need to see our 4-5 to complete the top of this cycle, which, again, could lead us anywhere to about 100,000, 150,000, who knows, maybe even go to 200,000. But, in that sense, we're seeing a big divergence in the charts when it comes to Bitcoin and the equities. And I also wanted to point out an interesting idea that I saw on Twitter recently. Now, I forgot exactly where, I couldn't find the original tweet, but it basically talked about the length of the halving cycles. Now, we know that, the halving cycle is generally an important event. So people generally expect Bitcoin to appreciate following the halving cycle, right? We've seen this happen already in all the previous instances. But, if we actually look at the length of the Bitcoin cycle, let's say from bottom to top, we can see that this has actually been shortening, right? Now, if we start here with Bitcoin's first, since Bitcoin first started till it topped following its first halving cycle, that took about 1,188 days. Looking at the second cycle, it took us about 1,065 days from the time we bottomed here, about $130, to the time we topped in about 2,000. Now, back in the 2018 cycle, we bottomed here at about 2,700, and 821 days later, we topped here at 60,000, right? That was the most recent cycle, not the 2018, sorry, the most recent cycle. And of course, if we count now from the bottom, assuming that this is the bottom, which is my analysis at the moment, now we'd expect to top, if we follow this idea that the cycle should be a little bit shorter. I mean, this should top at some point, not too much after the halving cycle, right? So if we took, for example, around 700 days, we'd be looking at topping maybe October 2024, November. Now the halving is scheduled for around April 2024. So this is kind of in line with the idea that, and again, this has been floated around by a few people that, this time we're going to see a big front running of the halving cycle, right? So we're not going to see such a big rally following the cycle, but instead we might see most of the action in Bitcoin happen leading up to the cycle. Leading up to the halving. And, this is very interesting and definitely something that makes a lot of sense. Looking at the early wave charts right now, I mean, we should be beginning our wave 3, right? And again, this could take us well into next year. And again, so we could be completing at the very least a wave 3, topping around the halving, maybe then seeing a little bit of a sell-off, and then a bit of continuation after the halving. But again, if that wave 3 is happening now, then yes, indeed, most of the juice of this rally will be squeezed before that halving. So definitely something very interesting to look at. And again, in line with the technicals and in line with the idea that equities are going to go down from here, and that credit event is going to propel Bitcoin, and we're going to see that kind of divergence. And to add to that, also, I wanted to show you this tweet from Coiner Yadox, okay, where he makes a comparison between gold in the 70s and Bitcoin today, right? You can see that in the 70s, gold had similar PAs as Bitcoin past years. Gold top at 1.2 trillion, Bitcoin at 1.28 trillion. Comparing them also makes sense, as Bitcoin often seen as digital gold, having similar properties. If we assume a similar cycle and a Bitcoin end cycle market cap of 5 trillion, which was the gold top in 1980, we could aim for Bitcoin 250,000 by January 2026. We also support the idea we're in the early phase of parabola. Okay, so again, kind of interesting to see this comparison. And obviously, I do subscribe to a big extent to the idea of Bitcoin being digital gold. Pros and cons there, but definitely interesting to see. And this pushes us out, further on after the original this halving cycle. And obviously, I do expect Bitcoin to enter a bear market following the halving cycle, and then obviously continue. So, this could be looking into the next cycle. And this also kind of in line with the idea that, during this, I've also talked about the idea that this coming decade could be kind of similar to that 70s, 80s decade, with that more persistent kind of secular inflation, and again, outperformance maybe in commodities, Bitcoin. I've talked about international equities as well. So it's definitely going to be interesting. And I just thought I'd point out this chart. Now, speaking of inflation, and of course, very relevant to our discussion is oil, right? So energy is definitely going to play a big role in where we move now in terms of inflation. And it's going to be a determining factor, for example, in determining the Japanese yield curve control policy, right? Because ultimately, if inflation persists in Japan, they're going to have to tighten monetary policy, and that is going to unwind the yen carry trade. And oil, of course, big correlation with inflation. And, we've really seen oil pop in the last month. So we've seen a very strong rally there. And, my assumption for the moment is that we could see oil head higher from here, right? So if we actually look at this structure that we have since we bottomed back in 2020, the way I see it, we basically bottomed in a wave 4, just above the 38.2% retracement. So, kind of a shallow wave 4, but, pretty much in line with what you'd expect, a big kind of distribution, slow grind down in wave 4, which would mean that we're now set to take oil back up to, over $100. I'm looking at around the $120 handle for oil. So with that said, the recent impulse really gives us some evidence that we could have already struck that bottom. Now, we did reach a bottom back here at around $57. We got a lot of sideways movement. The way I see it, this could all be part of an ABC structure, which is part of our initial diagonal back into that market top, right? So the 5-way structure within our wave 5, okay? Something like that, basically. And this would imply that, with this latest, now this was a very clear impulse. So, we can count that as the five-way structure within this wave C. So that would imply that at the very least now we're in for a retracement, right? So let's look at the moving averages as well, just to get a good sense of this. So if we measure this impulse from here, or rather this whole ABC structure, right? So if this was our wave one, then we'd be looking now at retracing towards, 61.8% retracement takes us here to $64. If we look at the daily chart, this is a little bit below the moving averages. You would expect to see some strong support coming in here at about 78. But of course, in terms of volume, we have a lot more support coming in here around 64 in terms of volume support. Interesting to note also that we are, nearing a golden cross on that daily, where the 50-day moving average could cross over the 200-day moving average. And also, if we look at the RSI, we are quite overboard here and kind of starting to build a divergence with, we've seen the last few weeks, oil continue to grind up, while the RSI really not quite being able to make higher highs here. So, and I did close a position on XLE and I did close my position on XLE recently. Now, moving on to the NASDAQ and the SPX, we can also see a little bit of a divergence. And we pointed out quite a timely manner that NDX was looking very toppy. Of course, we had a divergence in the RSI. We were approaching major fib levels, all right? So we can see, for example, that we were getting very close to the 1.618 extension of our large impulse here, the 1, 2, 3. Also, on the slightly smaller time frame, if we look at the smaller impulse, we were also exactly at the, getting just above the 1.618 extension there, approaching the 2 extension. So also basically hitting our fib targets quite accurately. And, though I talked about perhaps pushing a little higher, I did actually, say that we had a good setup to short the market around here. And indeed, it's played out quite well. Now, we are entering an important area of support here. Obviously, we have this trend line here acting as support. And basically what I expect now from the NASDAQ is a bounce, a corrective bounce in a B wave before we resume our sell-off in a wave C. Now, watch out for this wave C because, it could get quite nasty. But before that, I would expect a little bit of a bounce here. Now, if we look at the RSI now, we are beginning to be a bit more entering the oversold territory. So definitely potential there. Point out also that, we're kind of coming down here in this wedge, descending wedge. So, breakout now wouldn't be unheard of. And, while I expect the NDX to bounce here in a B wave and not break its previous highs, the SPX I see a bit differently. Okay, first of all, if we look at our XPX count, I do count this as a wave 4. Okay, so this was the larger 1, 2, 3. We have a smaller degree, 1, 2, 3, 4, 5 here. So SPX, my target has always been a little bit higher, 4,800, definitely more in line with what we'd expect. But, again, we can notice that we are starting to get towards resistance. We're getting pretty much tapped this level here, that top we got in this initial bear market rally. But, so far we're maintaining a bullish structure, which is, of course, this bull flag, basically, yeah? So, and a structure that we've seen before. So as long as we can hold above this very important level of support, again, we have SPX here at the level of the trend line and holding, just holding just above that 50-day moving average. So definitely, which the NDX broke below. So definitely looking a little bit more bullish and looking very good here for what I'm expecting to be, again, that little bounce in a wave 5, give us that marginally higher high before, of course, a much more substantial retracement in a wave 4. And again, if we just want to have a look at the fib levels, hypothetically, a wave 4, which could take us somewhere in the ballpark of 4,100, maybe even a bit lower. But and now, just to wrap up, I also wanted to talk a little bit about gold and natural gas. Now, gold, as I mentioned on Wednesday's newsletter, I'm beginning to doubt this structure that we have right here. We are reaching a very important level of support. We have the 200-day moving average there. And, if we zoom into our structure here, if this is, of course, a 1-2, we're now basically at the bottom of our target. I mean, yes, we could retrace all the way down here, but, the 78.6% retracement, which is where we are now, is really the last sign of support kind of for this wave too. Yeah, it'd be rare to see it go below this and recover. So, I'm kind of 50-50 now, kind of leaning towards the idea that we could get a much deeper retracement. And if we actually do look at the Fibonacci levels now, we did get pretty shallow retracement, right? We barely even touched the 38.2% level here at 174. So a fall to 169, 164, very much in line with what we could expect. Very much in line with the targets shown by the fibs. And, we're definitely going to have to watch out for that. Of course, the RSI now is getting a little bit oversold, so we could see a bit of a bounce. But, overall, I think there's definitely room to go lower. And, so definitely watch out for that level of support, because basically if we don't turn right here, my assessment would be that we are going to fall back below the lows we made here in June. And now, of course, as I also mentioned in my last video, we have our trade going on natural gas, playing it through UNG. And, we did get a very substantial breakout here after falling here back to we did get a substantial breakout after completing this ABC structure and forming marginally lower low. And, as you would expect, we broke out very aggressively. And now we've had a retest of this trend line. And, I'm holding on. Yeah. So we're definitely in a very good place now to basically break out into this $10 zone over here, which is our target for our wave 3. Yeah. So again, measuring the wave 1 from the bottom of 2, and this 1.272, 1.618 extension is our target for natural gas. So still very bullish on that. Natural gas very oversold. It will be interesting to see, because oil I do expect to go down, but natural gas I do expect to go up here. And finally, the DXY. And again, the fundamentals are kind of showing me now that the dollar is probably maybe poised to continue going higher. Now, I did originally talk about this structure, an ABC, where we got a 5-way structure, which took us much lower. But, if we actually look at previous instances of this structure, which I did point out, it's interesting to see that, look, for example, right, we got this structure back here. That's the A. Measure from the top of wave B. Where does C land us? 50%. Once again, we get an initial move down, then a little bit of a bounce from wave B. And where does C land us? 50%. Okay. Same thing here. What happened? We've got an A wave down, a bounce back in B, and a breakdown to just about 50%. And, the action now is looking a lot more bullish. So, we could contend that this count is done. Yeah. So this was basically ABC down here. And then we are, in fact, heading back up. So at the very least, to retest this trend line here, 115. And of course, that would be in line with our idea that, some of the risk assets could go down, and also oil could go down a little bit from here. So definitely something to watch out here. NDX, of course, breaking above that 50-day moving average, and momentum now certainly to the upside. So, got to watch out there in terms of the NASDAQ and even Bitcoin as well, which we could see a little bit more of a retracement in based on the halving cycle and the idea of the cranes event. I'm definitely leaning a lot more bullish on Bitcoin. Okay. So that's it for today, guys. Hope you enjoyed this weekend update, and see you in the next one.